Gives me great pleasure to welcome on board the renowned name Russel Napier on the show today, the global voice who's been changing his view after, I think, 2 decades and switching from, talking about being a deflationist to an inflationary stance. I mean, this is huge. And Mr. Napier, it's great to have you with us here on ET Now. We really want to get deep into this with you and try and understand, what really is the trend that you're predicting, why you've changed that view, how you see inflation playing out, and whether you feel a big deflationary crash is coming soon.
Sure. Well, thanks for having me. I have changed my mind, and I changed my mind because the facts have changed. And the facts are how we create money. And that's the most important thing. The way we create money has changed. So I just want to take a little bit to talk about this revolution in how we create money, because that is the basis for the second bit, which is how it creates inflation. We spent 10 years, certainly in the developed world, with central bankers trying a thing called quantitative easing, which was buying assets effectively from savings institutions, crediting those institutions with money that didn't exist that day. Those savings institutions, by law, had to invest it in financial assets. So we had this great ramp up in financial assets. Now that is still going on, but something much more powerful is now going on, which are government credit guarantees to banks. So the United Kingdom is a very nice little example. We have a thing called the coronavirus bounce back loan, and that is the government guarantees that loan if it goes bad, but the bank makes the loan. It's not fiscal policy. The bank is making the loan. The banks have extended their balance sheet. Bank credit has grown. Now, the most important thing to know about money is that it's created by commercial banks. And when commercial banks extend their balance sheets by making loans or buying government securities, they create money. So they haven't really succeeded in creating money under quantitative easing for 10 years. But with the Bank Credit Guarantee Program, they now feel safe to make these loans. And it isn't just a British phenomenon. This is happening in Australia. It's happening all over Europe. It's happening in the United States. Now, the crucial thing about that is this money is now made by government. It has nothing to do with central bankers. The government have now taken over that bit and they're creating the money because the central bankers failed to do so. Now, we could maybe talk in more detail about the consequences of that, but we should be in no doubt that for the first time in my professional career, governments, certainly developed world governments, are in the business of creating money, and they've wrestled that power away from central bankers.
I absolutely do want to talk about the consequences of that, because I've been reading a lot about your theories on this, and some of the debates as well with others, on really how this could have a potentially disastrous fallout. Why is it that then the governments, for example, can't see this, or is it just too short-sighted a view trying to override the current economic situation?
Yeah, I think it's an overcompensation. I mean, I think they realize that we're in a crisis that central banking can't solve. That's the first thing. We're in a crisis, going into a crisis with, for many of them, but not all of them, incredibly high fiscal debt to GDP ratios. So now there is this third way. I like to call it the magic money tree. The Prime Minister of the United Kingdom said there is no magic money tree, but they have discovered this magic money tree. So the reason they're doing it is they're terrified of deflation. And I think the market agrees with that. If you look at the yield on government bonds, the market is also frightened of deflation. They're frightened their central bankers have run out of power, and they're doing this. Now, I would argue that they don't fully understand the consequences of it. I mean, that might be a little bit arrogant for me to say so, but listening to what they're saying, I'm not sure that they fully understand just how much money they are creating and what the consequences from it are. However, my main point is that this is such a powerful political tool that it won't be abandoned. So when I have these debates, as you mentioned, one of the arguments is there's a temporary movement by government towards this, and then they will stop and withdraw. And because this is so powerful politically in terms of who it gets money to, I believe not only will it not be withdrawn, I think it'll be extended. And therefore, the power of government to create money will grow and grow and grow.
And this has so many other ramifications as well, right? In terms of just ballooning debt we're anticipating, and then the impact of that on whether it's currency, trade, so on and so forth. How do you see this playing out, let's say, over the next decade?
Well, so first of all, the easy thing to say is it plays out with inflation. So I think that's the easiest bit. Now, we don't know if it's this year or next year or when it is, but the whole point of this policy is to actually generate more inflation. You've raised many bigger points than that over the next 10 years, particularly exchange rates. I think one of the most fascinating things will be who doesn't have to do this. This is part of a wider policy, which we know as financial repression. And I think most of your viewers, if they haven't heard of it, they should Google financial repression and get a good idea what it is. I would, for your Indian viewers, I would say it's a bit like the license Raj. That is kind of what financial repression is. And this time it's definitely coming to the West. I think the fascinating thing about India and some other key emerging markets is you may not have to do it, because actually your debt to GDP levels are at remarkably low levels by global standards. And I think it's half. You've probably got half the level of debt to GDP that a country like the United States or the United Kingdom has. So I think one of the most fascinating things over the next 10 years is what will happen in countries like India, who may be able to get away with this. I mean, it will be a tremendously positive thing for any country that can avoid this, because you've got to remember that if we head into this scenario, it drives out savings. Savers will try to escape a situation where inflation is here and interest rates are here. And where on earth will they escape to? Because the entire developed world is in exactly the same situation. So there is a wonderful opportunity, I think, for some countries such as India to attract a lot of capital. But if I was to talk about everything it means in the next 10 years, we'd probably be here for 10 years because it's a very long and big subject. But I think, the crucial thing is capital will try and exit anywhere that pulls off that repression, keep interest rates here, put inflation there. And one of the more fascinating and interesting things is, where's it going to go to? I mean, gold is the obvious place it's going to go to. But if India and other countries can avoid the same license Raj policies, and I think that's the wonderful thing about India. I mean, having just not that long ago come out of the license Raj, you can see the downside of going back into it. Whereas here, it's 40 odd years since we left our version of that system. And I think memories have faded, and some people look back on it with great favor. But I think in India, it's so recent that I don't really see policymakers wanting to go back into that, and you don't have to.
Sure. Do you also see, given the damage that we're seeing globally, that we might begin to see a wave of very critical bankruptcies in major companies, even perhaps in some of the key EMs? We haven't seen that yet, whether it's, a Nigeria or Brazil, or, people that, countries or companies that you would think would be at the brink.
Yeah. No, I don't think so. And one of the most powerful things that's gone on in this crisis, which is not really commented upon, are the swap lines that go out from the American Federal Reserve to other central bankers. Now, if we look back at any emerging market crisis, it's really been the same crisis. It's been they borrowed too much in dollars, and when the local economy contracted or asset prices declined, they couldn't pay back the dollars. And that's exactly what would have happened in 2020, except that we now live in a world where the Federal Reserve balance sheet seems to expand to infinity. And those credit lines from the Federal, effectively credit lines, swap lines, go out to the entire system. They go to central banks. The central banks then lend them to the people who are struggling to pay back their US dollars. Now that, you might say, it's not a permanent solution, but if it's a world of COVID where we get slowly normalize, that holds the world together. So actually, I mentioned earlier to you when we were chatting, I'm in the process of writing a book about the Asian financial crisis, and the contrast is really marked, because when those companies and countries ran out of dollars, then there was nowhere to turn to, and they went bankrupt. But this time there is. So I think what you're alluding to is a kind of surprising solidity in emerging markets.
Yeah,
so
exactly.
Let's not rule out the power of these swap lines from the Fed to hold everything together. Now, ultimately, the economies have to come back. They have to come back. And one of the great overlays on how quickly they come back will be China, and the extent to which we are still doing business with China, not doing business with China. But obviously, if we got to the stage where we stop doing business with China, it's going to be a lot of good news for other emerging markets. So I don't see those mass bankruptcies that are talked about. And generally speaking, over the long term, higher inflation in the developed world is good for the emerging markets. It's good for the emerging world, because the emerging world is selling a lot of stuff to the developed world, and if they get slightly higher prices, that's a good thing. So I don't see us going in that direction.
So let's say in terms of markets, currency, we start to see that shift when it comes to the emerging world, particularly from an India standpoint. What about also from a fund flow point of view? Do you also see increasingly more more fund flows into emerging markets, specifically like India? And if so, how should investors really be positioning themselves, and what are some of the signposts that they should be looking out for to see that this is a trend that's actually going to start to play out?
Yeah, well, it will come in stages, and that, the main point I made about financial repression, license rise, that's the long run. It's not necessarily anything that's going to affect markets in the next 12 months.
Okay.
What will affect market in the next 12 months is if we do have this early stage reflation. Well, I think it'll happen. Clearly, I'm in a minority. The consensus doesn't think it's going to happen. But
Right.
the history of early stage reflations is they've always been positive for equities. And that would be, that would be American equities. Again, that would be British equities. That would be European equities if we get that early stage reflation. So in that stage, you don't see a lot of money kind of spilling out necessarily to the emerging markets. The stage at which you see money going to the emerging markets is as inflation comes back and as interest rates go up. But the really telling sign of this repression is a move to cap interest rates, cap long-term interest rates. Now, I would argue strongly that that is a huge buy signal for most emerging markets, assuming they're not doing the same thing, assuming that they are refraining from similar policies. That is the key trigger point when savers in the developed world say, this system is rigged against me. Not that this yield is rigged against you, but the whole system is rigged against savers, and that's what a financial repression is. So when will that be? I'm just about to write a report on that for my clients, actually. I don't think it's going to be in the next 12 months, actually. It could be, but I really don't think it would be. So I think, for next 12 months, we could see developed world equities doing quite well. But the real trigger for emerging markets will be when they decide to aggressively get into a yield cap. Some people think that's happening, but actually it's capping yields when there's a low expected inflation is not that difficult. What I'm concerned about is what happens when we do believe in inflation, which obviously we will at some stage. How you cap yields then. So bonds, do they produce positive real returns? No, they're pretty negative, but they can produce exceedingly negative real returns if we cap yields as inflation rises. And that, I think, is when the money spills out and looks for other opportunities. And I hope that other emerging markets have not been as stupid to do what we're doing, and therefore they would be beneficiaries of this.
Okay. I'm just soaking in the theory, and you're right when you say that the arguments are so stacked up against the inflation debate. Also because maybe it just seems that governments have been able to get away with printing money for a really long time. So there doesn't seem to be anything that every time we think there's a crisis, we seem to get past it. So is there a case for it to be different this time?
Yeah, so I'll run through the reasons why it's different this time. So this is not being created by the central banker. So in the past, it's been the central bankers who created money or failed or succeeded to create money. Yeah. As I've already mentioned at the start, this is about government creating money. So the crucial thing is where it's going to. Now, we've got 35 billion in loans out in the United Kingdom. They all went to small businesses. The maximum value you can take on that loan is 50,000 sterling. So that is not going to the massive companies of this world. They're going to the smaller companies of this world, and many of these loans are for smaller. These companies spend it. They're not like multinationals. They don't sit with 500 million on the balance sheet in cash. They spend it and they give it to their employees. So this is money that circulates quite quickly. So that's the first thing. The second, governments are creating money, but they're getting it to people who spend it, which didn't happen with quantitative easing. Yeah. The third thing and the important thing is that they're increasing these programs. So for instance, Spain did a 100 billion program. As soon as it ran out, they increased it by 40 billion. So I think the direction of travel is also clear that we'll have more and more of this. And finally, it really does help you get elected. The reason that we took the ability to create money away from governments in the first place is that they found it very useful coming up to elections to hand out lots of it. And here we are again. So those are the reasons why I think this is different this time. And just to go back and be absolutely clear, you don't say this every 5, 10, 15, 20, or even 30 years. This is a new monetary regime. So we've been used to an old monetary regime. Central bankers make money. We're now in a new one. And I think the markets are entirely ill-equipped to deal with that new one. So this time is different. We change monetary regimes very infrequently, but we just changed it. And I think basically nobody noticed.
That I agree with at this point of time. When it comes to gold, you mentioned it before as well, the gold, silver, even Bitcoin as asset classes of choice, perhaps going forward. How much merit do you find in some of these assets, and how much of a bull run do you actually see coming in commodities?
So Bitcoin, I have really no comment on. I know nothing about Bitcoin, and we'll leave that up to Bitcoin experts. But I personally don't buy it, nor would I buy it when there is gold available. So gold has got something slightly easier to explain, just because as a financial historian, I can look at the long history of gold, and least tells me something about how gold might respond to inflation, deflation, repression. And I look at Bitcoin, and I don't really know how it, I mean, there are people who know more about it. They might know how it responds to those, but I certainly don't. Yeah, so gold, we have gold is the asset for financial repression. Remember what financial repression is. It's trying to get your savings and put them somewhere where the government wants them to be. And back to the license tragedy, or we do this really through the regulating the financial institutions. So we would mandate that if a savings institution which looks after my money would have to have half of its money in government debt, for instance. So that is where gold comes in, because it is this asset which is, well, it's slippery, isn't it? I mean, it's quite slippery, as you know. In India, I mean, you know the history of gold in India. It slips in and it slips out, and that's been going on for centuries, and it will continue to have that function. And people are always worried because you remember in 1933, I think it was, President Roosevelt tried to sort of confiscate people's gold. That we could get to that, but it's really so far away. What we've got to remember is this: is that if I was a government looking for money, I have this huge pot of money in regulated financial institutions, much more than I did in 1930 or 1940, 1950. So if I can regulate that money, I don't really have to go after anybody's personal holdings of gold. And look, if things get really, really desperate, maybe in the end I go after that, but it's actually a very small sum of money, and there's this great big pot of money for me to get my hands on. So if inflation is here and interest rates are here, that's already good for gold. But the reason that interest rates are here is because the government's forcing me to buy that stuff, then that's even better for gold. So gold is a standout financial repression asset. And silver, I'm not familiar with. I wouldn't like to comment on it. And I know there's a lot of people who are even more bullish on silver.
Okay, so clear case for the precious metals coming in there. When do you see the US reindustrializing? Is that something that you predict happening? And if so, how, when do you see it playing out?
Yeah, I think that's happening globally. It's not just about us taking actions against China. There's a much bigger story than that. Chinese labor itself has been, it's on a fantastic run. The people of China are so much wealthier than they were before, but robotics is a major, major issue here. I mean, the robotics are getting more potent and more potent, and therefore you can have these robotics anyway. The cost of labor becomes less and less important. So I know the great sort of story is that we bring all the manufacturing back to the developed world and it creates lots of jobs. Well, at the margin, it definitely creates jobs. Right. But the robotics are really getting to such a level that it's freeing up, I think, where capital can go. The capital's constant search for cheap labor is still there, but not in the way it used to be, given where the technology is taking us to. So, I mean, I think the story is more about the emerging markets, really, if particularly if we cut China off, to the extent that anybody still needs relatively cheap labor, then they will be going to places like Vietnam, potentially places like India. But so much of this now is probably going to machines rather than human beings, which has its own challenges for all of us.
Without getting too deep into the intricacies, but India in the global context, just in the capacity of the way these trends are playing out, do you feel that we will emerge stronger for it, let's say over the next, I don't know whether to say a decade or 3 to 5 years, but what are the signs that you're seeing, and what do they tell you?
Well, the longer term trends, I think, are very positive for India, getting more so from this rather than less so from this. And part of that obviously is China. And there's no doubt which side of the divide India is on in terms of the US-China divide. I mean, it's pretty obvious which side India is on, and I suspect it will stay on that side. So it should benefit from what isn't done in China. I think some of that can clearly come to India. Being an ally of America has its upsides and its downsides, but one of the upsides is you do expect more capital coming in. I think higher inflation in the developed world is actually good for India. I mean, we know that India struggles with inflation, particularly food inflation, which is a terrible problem for India at times. But in a world of higher global inflation, with India gaining more exports, that's going to be good for India as well. And but the most crucial thing of all, and I can't stress it enough, is that I think India is smart enough not to go the same route as everybody else. And really, I can't really explain how positive that would be for India if it took a different route for everybody else. And the reason I'm positive is not just because of your recent experience with it, the bankruptcy or that whatever you want to call 1991, that near terrible experience. It's not just that. It's that the debt to GDP levels in India are really very low, so there's no need to do it. So I do worry sometimes that India looks to the rest of the world, sees what the rest of the world is doing and takes it as a template. But actually, you're in a unique situation to go in a different direction. I think it would be incredibly positive. But it's a political decision, right? So we don't know for sure. So I'm sitting here kind of with my fingers crossed that India goes in that different direction.
Talking about politics and given what we've been talking about, how critical are the elections going to be this time around in the US?
Well, we say this every time, don't we? I think not as important as everybody thinks, because I mean, to me, I mean, apart from all this stuff about inflation, the most important thing is the relationship between America and China. I mean, that is going in a very dangerous direction, and I don't see that actually it changes much under a Biden presidency. That would be the crucial thing here. So I can't see how we get away without having a Cold War with China. People say, well, Cold War, and then we move on to the next subject. But people don't pause and think long and hard about what a Cold War actually means. I mean, we don't trade with China, they don't trade with us. We don't invest in China, they don't invest in us. We could very easily be in that situation. And frankly, I don't think the US presidential election makes a lot of difference to that. So therefore, I don't think it makes a huge difference in terms of financial markets around the world. I think the Democrats will be as, I don't know if anti-China is the right word, but they'll take a strong view on China, as President Trump has taken a strong view on China. And for anybody taking a longer term view, the US-China relationship is the absolutely key thing to get right. And it'd be nice if it turned out that they were all able to hug and make up, and then we would have to have a very different outlook. But if so, we need to look at that as well. But we need to get that call right. And I just don't think this election changes that particular call.
Okay. What do you make of the kind of tech boom or value creation that we're seeing on those tech stocks? Is it all going to come crashing down, or is this now the way of the future?
So I'm recommending my clients that they buy value stocks, which they usually throw their hands up in horror and run out of the room. That is a reaction I've only had twice before. I remember very well in the Asian economic crisis in the middle of summer of 1998, recommending people buy, and they just kind of laughed and threw their hands up. And also recommending people buy in the first quarter of 2009 for US equities, and once the same. This is what I would call revulsion. I've been doing this for 31 years. And you hear the word revulsion in the textbooks a lot, but I've hardly ever seen it. I would say this is only the third time I've seen it. So when you see people so revolted by one asset class, I think it means that asset class is a buy. But secondly, I think it means its antithesis, and its antithesis is growth, tech, is also overvalued. So I have not been anyone who's called the tech boom. I'm not a tech expert, and I certainly didn't see this coming in technology. But the discrepancy in valuations are so high that I don't have any problems investing my own money in value equities. They are as undervalued as they've probably ever been, and I'm very aware of the downsides. There's value traps in there which one has to avoid. So yeah, I think we'll have a very prolonged period now where value outperforms tech, and I think inflation can be the trigger for that. So the problem with the value stocks is they haven't benefited from higher nominal GDP growth. Nominal GDP growth has been really, really low. I'm obviously an outlier. I think it's going to be very high. And if you're a kind of boring old industry, you kind of rely on GDP growth to put your revenues up. So we're going to finally get that. So that would be a major outperformance for value relative to tech growth.
Okay, fantastic. So if you had to kind of break up the allocation, how would you suggest doing it between, the value equities, gold, etc., maybe some tech? How would you advise?
Yeah, so so gold is an interesting one. And if you look back in history, say the late 1960s. Sorry, if you look back, say to the late 1960s, the place. Sorry, go on. Yeah, I was said let me throw in emerging markets. Okay, yeah. So if you go back to the late 1960s, the place to have your money in gold, with the benefit of hindsight, looking back, it should have been basically all in gold. And nobody had the guts to do that. That was such a huge outlier. So, I think you should have as much money in gold as you feel comfortable with, given where the world is going to. And that will be radically different depending on whether you're a professional investor or an amateur investor. But I think even as an amateur, you could go as high as a third in gold. I think it's that much of a setup for gold going forward. So you should have not, I mean, these are extreme forecasts, but you should have nothing in bonds. There's just no upside in government debt. Now, government debt would usually form a huge proportion of the portfolio. So if you instantly take government debt out of the portfolio.
Such a pleasure, Mr. Napier. And I hope you will send us your book once it's out. We would love to read it, and look forward to having more of you here on ET Now.
Okay, thank you very much.